Hey everyone, so as you know, I invest for dividends and cash flow. And one of the stocks that I've held in my portfolio for many years now, since 2011, I check my stocks every day on my phone, and one day, just in this past week, I was scrolling down and it was up 25%. In one single day, one of the stocks that I own, that I've owned for a long time, it's been a steady grower. It's done very well over the years. It's steadily grown in share price and also in the dividends that it pays. And all of a sudden, it was up 25% in one day. I want to share my experience with this stock today and why I am actually incredibly unhappy. I am so unhappy that it is up 25%. I am talking about Dr Pepper Snapple. Hey everyone, this is Ian. I'm from ppcian.com. I am here sharing insights about investing for dividends, passive income, and cash flow. I own this stock, Dr Pepper Snapple. I've owned it for a long time. It's always been good to me. For those that don't know, this is a stock in the United States that is a beverage company. They are most known for their brand of Dr Pepper beverages and Dr Pepper soda, obviously. This stock has done so well for me over the years. In fact, in my early days on YouTube, about 6 months or so ago, I did a video about Dr Pepper and how it has driven a great yield on cost for me. It's never been a high yielding stock, but because they raised the dividend so quickly and so predictably, my yield on cost is fabulous, and I'm going to share that with you later. But basically, this company has done well for me. It's been a steady grower over the years, but all of a sudden, it just hockey sticked. Way up, 25% in one day. And so when I see something like that, I'm on my phone, scrolling down. What is going on? It got acquired. This company is going to be acquired by Keurig company, the company that makes the Keurig coffee, those little Keurig K-cups that go into the coffee maker and many people use for coffee. I've got one of them here myself. And they're going to be acquired by Keurig. And what's going to happen is Keurig now is a privately held company. What's going to happen is the combined company is going to go public. And so my shares in Dr Pepper Snapple, there's two things that are going to happen. Most of the shares are just going to be acquired, and I'm going to be paid out a one-time cash dividend in terms of cash. The rest, I'm going to have a small position now in the combined company as well. And so I want to talk today about my experience with this type of thing, what it means, and why from a dividend growth investing standpoint, it actually is not advantageous. These types of M&A, mergers and acquisitions, for a dividend growth investor, one actually doesn't want to see this kind of thing. At least in my experience, I don't like seeing this. I really dislike seeing this, and I want to share that today, why that's the case, and hopefully share some insights with all of you. So, as I always do, I've got my notebook, and let's just go through some numbers. So I am already up substantially on this company. I have held this company since 2011, about 7 years, and I am up 231%. Capital appreciation does not even include the dividends. And so that 231%, it includes actually the recent 25% spike. But the fact of the matter is this 25% spike, in the scheme of things, it's inconsequential for me. I can't pay the bills with capital appreciation. I don't invest for capital appreciation. It's nice to see, but if I'm already up a lot, another 25% just does not really concern me because I invest for dividends and cash flow. I invest for dividends that I can pay the bills with. And my yield on cost for Dr Pepper Snapple, it's great. After holding this for only 7 years, I am yielding 6.38%. 6.38%, you cannot get a consumer, non-cyclical, world-class brand like Dr Pepper Snapple in this market. The best one can hope to do on something like that is a Kimberly-Clark or Procter & Gamble, which are in the 3% range. I have double the yield on my Dr Pepper Snapple just because I bought it, I held it, they raise the dividend each year, and my yield on cost, meaning the present dividends divided by my starting cost, the cost that I paid for my shares, is 6.38%. That is the magic of dividend growth investing, and that's only after 7 years. Imagine if I hold this for 20 years. My yield on cost could be anything. It could be 20%. It could be much higher than it is now. And so the reason I am disappointed is I would have liked to just hold this stock. I would like to hold it forever. I would like to see my yield keep increasing, because one day the amount of passive income and cash flow that would have come my way from Dr Pepper Snapple would far outweigh this 25% bump. Here's an interesting way to look at it. If I hold this thing long enough, I would receive 25% a year yield on cost in cash dividends every single year. When that's the long-term vision, why would I care about 25% one-time gain, especially now that I have to redeploy the money elsewhere? So fact of the matter is being a dividend growth investor is very different than being other types of investors. And most investors, they see something like this, they're like, wow, that's great, Ian, up 25% in one day, you should be really happy. No, I am not, because that is very short-sighted. I am in this for the long term. I am in this to yield 25% a year in cash dividends alone. So some nuances here with Dr Pepper Snapple. I'm not an expert on this yet, because they literally just announced it, and time will foretell what's really coming. But it sounds like what's going to happen is there's going to be a one-time special dividend. Thankfully, if this is executed as a dividend, my cash payout is a dividend, at least it will be taxed at favorable rates. At least that's something they did right, because if it were just a one-time payout and it were coming as ordinary income, that could be taxed at a higher tax bracket, although I have held my shares for a while, so it would be long-term capital gains. But anyways, the way that they are approaching this as a cash dividend, at least that was something I liked, because it makes it crystal clear that the tax consequence is going to be treated, most likely, hoping, as a qualified dividend, which would get those lower tax rates. So that's a good thing, at least, is I'm not going to have a huge taxable event. But the fact of the matter is aside from losing that opportunity cost, the opportunity cost to have an even higher yield on cost, the opportunity of these dividends to keep growing, in addition to losing that, the other reason I dislike these types of mergers and acquisitions is they can create taxable events. And I don't want to deal with taxable events. I like to just buy and hold forever, especially when a company is great, like this one, like Dr Pepper Snapple. So, as I had mentioned already, here's another troubling aspect of this M&A. I'm going to have a very small stake going forward in the combined company. Very small. And I'm going to do a video on this, but it's likely going to be below my minimum threshold. I have minimum thresholds in my portfolio. If a stock doesn't reach a certain size, it's not even worth owning. It's inconsequential, unless I plan on quickly adding to it and growing its size. Maybe the combined company, it'll be good. They'll pay a dividend. I'll want to add to it. Maybe it will become a future position that I want to own, but typically I like to own companies that have been around a long time, that have a lot of track record to go on. And I just don't know about the Keurig company. I don't know about their track record. And I don't know what their policy is going to be on, quite frankly, with dividends. If they're not shareholder friendly, if they're not dividend friendly, if they're not dividend growth oriented, I certainly don't want to be part of that stock. So this could be a headache for me, in the sense that I'm either going to have to sell this small position because I don't want it. It's not dividend oriented, and it's just inconsequential in my portfolio. Or I'm going to have to add to it to bring it up to my minimum size, because I'll talk about this in a future video, but if a stock doesn't have a minimum dollar value in my portfolio, it's just not even worth having it. It's not worth the headache, the hassle, the time of having it. So things for me to think about in the future. Obviously, I would rather just keep things as is. And this is something, one of the reasons I'm sharing this video with everyone is this is something that will happen if you've been in the dividend game long enough. I had this happen to me on another position last year. And in prior years, I've had this happen before as well. When you're a dividend growth investor, you've made your best effort to pick stocks. You've made these commitments to these stocks to hold them forever. You're in it for these fantastic yields on cost that will pay for living expenses. Despite one's best efforts, over time, some of them will get acquired, and it won't always be advantageous from a long-term perspective. And so I'm trying to prepare all of you out there, because you will probably experience this at some point or another in your own portfolio. And I own over 30 stocks. One of the reasons, quite frankly, that I do own so many stocks is if I just had a handful and something like this happened, it would be more of a complex situation to figure out than if this is just a drop in the bucket. And so the fact of the matter is now that I have 30 stocks or more than 30 stocks, yeah, this isn't that much fun to deal with, but it's just one of over 30 stocks. And so it makes it a little bit easier to digest this type of situation. At the end of the day, this is probably a good problem to have. Look, I'm ranting here on YouTube about making 25% in one day. In the scheme of things, that is ridiculous. I should be blessed and thankful to be having this success in the stock market, and I am. But the point I'm just trying to make today at a high level is it is so different to be a dividend growth investor. It is so different. And most people out there, what they think is good is oftentimes bad for a dividend growth investor. And what other people think is bad is good for a dividend growth investor. And so the two cases are, let's look at these. This obviously good for most investors, bad for dividend growth investor because I'm foregoing this opportunity now in the future and I have to redeploy my money. But another thing just looking at is most investors out there, stock goes down, well, that's a bad thing. In my case, I love it when stocks go down that are in my portfolio. I just did a video about Southern Company. I'll link to it below. It's down. I'm taking the opportunity to buy. And so most people think that's bad. Oh, the price is down. I love it because when the price goes down, the yield goes up. And so I'm trying to remind everyone out there that when one commits to being a dividend growth investor, one invests for cash flow, for passive income, for the dividend check, most of what you do, or a lot of what you do, is going to be so different that it's going to be even difficult to carry a conversation with the average investor because they just look at things differently. They're all about the now, and they're like, wow, it's up 25%. Great, let's just move on. I'm so happy. But anyways, good problem to have. I should be very thankful. I'm blessed to see these type of results. And at the end of the day, you know what? I'll take the capital, I'll redeploy it into Procter & Gamble and Kimberly-Clark. And the fact of the matter is both of those, the starting yield is higher than when Dr Pepper Snapple is yielding right now. So to actually bump up my overall portfolio dividend income, which is, you know, maybe this is a blessing in disguise. So one of the closing thoughts I want to share today is portfolio diversification. I typically see this kind of thing happen with smaller companies. Their market cap plus or minus 20 billion range. It's possible for a company to acquire a $20 billion company. Let's talk about a company that's, say, 200 billion. Well, that's going to be harder. And so in my portfolio, I have stocks of all sizes. And I want to diversify by market cap. I don't want everything to be large cap, but I surely don't want everything to be smaller cap or mid cap, because if that were the case, the risk of this type of thing happening would probably be more prevalent. And so by diversifying large, medium, small, these types of acquisitions happen, but it'll typically happen with the smaller companies, and typically it won't be too many because I'm not overweight on smaller companies. But that's the downside of investing in a smaller company that's growing quicker. They'll be acquisition target. That's the downside. The downside of a bigger company is usually they're growing slower, but the upside of a big company is they're not going to get bought out, and so that opportunity to hold 30 plus years or more and achieve just phenomenal yields on cost is more possible. My name is Ian Lopuck. I am from ppcian.com. If you enjoyed the video today, I please invite you to give me a thumbs up, a comment, subscription, all that stuff. It means the world to me. It's the greatest way you can thank me, and I've just been blessed here on YouTube, receiving so much support. The channel is growing. I have huge goals for this channel. I just thank everyone out there who is watching and being part of this community. I am learning so much as well, and doing videos like this, it's making me a better investor. I'm doing more research than I have in recent years because I want to put good effort into these videos. So I thank all of you for upping my own game in my investment portfolio. Before I leave today, I do want to add a full disclosure. I am long. I own Dr Pepper Snapple. That's a stock in my portfolio. I'm also long on Kimberly-Clark and Procter & Gamble. I own those stocks in my portfolio. Ticker symbols of these three stocks are DPS, KMB, and PEG. I own all three of those in my portfolio. Also, before I leave today, just a friendly disclaimer that I am not a licensed investment advisor, and today's video is not investment advice. This video is just for your fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. I also want to let you know today, before we leave, check me out on Instagram. I'm sharing some cool things there. I'll link to it in the description below. If you want to see the books that basically shaped my entire investment philosophy from way early in the day, from decades ago, the books that I was reading, I'm just shared a photo of those on Instagram, and you can head on over there and see that. And please do follow me on Instagram. I will have more content there on investing that one will not be able to find elsewhere. It'll just be there on Instagram. So my name is Ian Lopuk, also known as PPC Ian. Thank you for watching, and I will see you in the next dividend investing video.